In this value investing model portfolio update video, we'll discuss 4 different topics. First, during the last 1.5 years, Tesla stock has crashed a whopping 70%. And that extreme downwards pressure has put Tesla in what I believe to be value territory. Second, while the recent 10% plus bull run in S&P 500 has been glorious, I do believe there's still significantly more downside on the medium term, based on a few macro indicators I'll show you in this video. Number 3, I did sell some stock for the first time in this portfolio. Of course, we will talk about what, how much, and especially why. And of course, as a closer to this video, we'll compare my performance against the S&P 500. And that is what you can expect from this video. Real quick, I want to share that this is my stocks and investing model portfolio funded with real cash with the purpose of building up a track record over time. With this series, we'll update you all on a roughly bi-weekly schedule. You can follow along. Now, with that groundwork out of the way, let's focus on Tesla as a value investment. I would have never expected, or dreamed for that matter, that this hyper growth stock would ever trade in value territory. But it did happen. First up, on the 6th of January 2023, I actually bought some Tesla stock for $102 per share. Not a large position, which I do regret with hindsight, but those 5 shares make up roughly 5.5% of this portfolio, and we are actually already up 16% on this position. That is some amazing stuff. But why did I, someone who mainly focuses on fundamentals and value stocks, buy Tesla? Isn't this company notoriously overvalued? Well, not necessarily. See, we are looking at a company that plans to grow. And I quote right here, over a multi-year horizon, we expect to achieve 50% average annual growth in vehicle deliveries. That is a lot of freaking growth. And if the company is able to increase their deliveries over time, surely over that same multi-year horizon, the company should be able to increase their profitability with a similar amount, right? Of course, margins could compress on the short term and demand could even dry up. A lot of things can happen on the short term. But my main thesis is that Tesla will be able to grow their earnings at a high double-digit growth rate for at least the next couple of years. There is this really easy rule of thumb from Peter Lynch, basically where you compare earnings growth to a PE ratio. If the growth rate you expect is the same as the PE ratio, the stock could be a buy. If the growth rate is twice the PE ratio, it could be a screaming buy. And basically, when I bought Tesla stock, I paid a 31 PE ratio, while I do expect the company to grow their earnings at 40% plus over a multi-year horizon. That is a pretty good deal in my opinion. And really, that is the main thesis behind why I believe Tesla has become a value stock. To me, this is a classic situation of finding an amazing business for a fair price. Similar to how Charlie Munger describes his investing philosophy. Now, of course, I have already made a more precise valuation model for Tesla, which in combination with a more in-depth company analysis, I would love to share with you all. Let me know if an entire video dedicated to Tesla as a value stock interests you. But for now, Tesla is just a 5% holding in this portfolio, which I would love to expand if the company goes lower in share price. I wish it does, but we'll see. Now, time for more downside. First up, I certainly ain't no macro investor or speculator. If I were to invest in a company, I would much rather focus on the business rather than the environment it's operating in. But sometimes a more macro view can help us make better investment decisions. I am going to show you a couple of indicators, which I would highly recommend you check out all for yourself, which paint a certain picture. First up, the 10-year treasury and 3-month treasury spread. Basically, this chart just takes the yield a 10-year treasury has, subtracts the yield from a 3-month treasury and plots that number on this chart over time. Now, what is peculiar about this indicator is that it's basically a perfect recession predictor. or at least it has done so historically, no guarantee for the future. Every single time that this chart has dipped into negative territories, a recession has followed on short order. It predicted the recession of 1982, 1990, 2000 and 2008 basically perfectly. And now this indicator is flashing red. This might hint at a recession hitting us in the jaw reasonably soon. That was indicator number 1, the yield curve, and it is mega inverted, meaning it is pointing towards a recession. Next up, the personal savings rate. This is basically the percentage that the average household in the US is able to save at a moment in time. As you can probably already tell, this number is basically at an all-time low. Keep in mind, this is not a recession predictor, but savings drying up can be a cause of a recession. After all, if households are running out of cash to spend, who else will spend to stimulate the economy? Okay, that was indicator number 2, the personal savings rate. And we are seeing the dry powder of households dry up quick, which is actually supported by our third indicator, total outstanding credit card balances, which have been increasing steadily ever since COVID happened. This one tells us that consumers aren't just saving less, they're actually going into debt to finance their lifestyle. And it is pretty worrisome to me. Households cannot go into debt indefinitely. At some point these households will have to pay back their debts, or at least default on their debts. So that was indicator number 3, credit card balances outstanding. And it is in fact pointing towards household liquidity drying up. And those 3 are just a tiny assortment of all the indicators we could look at. For example, inflation data is now finally trending down, and although this one is a lagging indicator, US GDP is still in a clear upward trend. So it isn't all doom and gloom. But from a leading indicator side, so the indicators we looked at, well, they aren't really painting a nice picture either. Leading indicators might just be pointing towards significantly more downside on the stock market. Now, what am I doing with this information and what can you potentially learn from that information? First up, I am not going short on the market. I fundamentally believe going short is a scam. After all, there's literally infinite risk if the stock goes up, and there's at maximum a 100% potential return. So no, I will not go short on the market, but there is still things we can do. For example, this portfolio is still at 32% cash. That is a lot of dry powder we can deploy over the next couple of months if and when value opportunities arise. Moreover, cash flows will hit this portfolio each and every month, which ensures that I can continue buying the dip. And there's still one more thing we can do to use this information effectively. During bear market rallies, sell those stocks that are close to intrinsic value. After all, that will free up some cash, and it also gives us the opportunity to buy those same stocks if and when they dip again. So basically, hold cash and sell stocks when your thesis plays out. At least that is my plan. Now with that out of the way, let's discuss my first sales. Number 1, I sold my 5 shares in BNP Paribas for a €23 profit, or an 8.5% return over a 1-month period. The main reason for this sell is I was expecting a significant catalyst in the 4th quarter of 2022, but it is now 2023 and it still hasn't happened. And we don't really know when it is supposed to happen. And there is a second reason. The company was inching closer towards the intrinsic value that I calculated for it. So basically, my risk was increasing from both the catalyst not occurring and the share price inching closer towards intrinsic value. And this is almost as if I planned this shit, but this is the perfect example of what we just discussed. Selling stocks that are close to intrinsic value to free up cash. I did sell BNP Paribas for about €60 per share, while I believe intrinsic value is in the €70 per share neighborhood. So even if the catalyst hit tomorrow, it might not have such a significant impact on the share price. Okay, that was sale number 1. But I did also sell some shares of ASTS, 25 shares in total, for roughly $5 per share. You see, ASTS is part of this portfolio as a short-term swing trade. Are expecting significant catalyst during Q1 2022, and ASTS is a very catalytic type of stock. But by selling small amounts during the uptrend, I'm effectively taking out my initial investment, therefore decreasing my risk exposure to this company. So this sale was just part of a de-risking endeavor, since I was already up 25% on this position. Damn, this is becoming quite a long video, but there's still one more topic we should discuss. Now it's time for the comparison. And for now, we are beating the S&P 500. We're overperforming by about 5% on the short term. And the portfolio is beating holding just cash by about a 2% margin. I am quite happy with this performance thus far. And in this series, we'll continue to see how my value investing skills stack up against the market. Now, here's what the current portfolio looks like. You can pause the video if you wish. Here is a quick overview from my broker. And lastly, the current limit orders I have outstanding. This was a long ass video, but hopefully you did find it informative. Please do let me know what you all think of this series down below in the comment section, and especially what you want to see during the next episode. Now, time for a classic YouTuber disclaimer. While I am a registered financial advisor in the Netherlands, I do not have the legal capacity yet to give anyone investment advice. Therefore, this video and any other video on this YouTube channel can never be taken as financial advice. I cannot be held liable for the losses you make while trading according to my opinions. Please do your own due diligence. And with that said, thank you so much for watching. I love you all. Peace.